Welcome. This video is brought to you by MyShoeCovers, reusable and washable booties for residential contractors with a grip you can count on. If you're looking to buy, sell, or invest in an electrical contracting business, one of the most important steps is understanding how to properly value it. While it may seem complex at first, the process becomes much clearer once you understand the core valuation methods and what drives value in a service-based business. In this guide, we'll focus on two of the most widely used approaches, asset-based valuation and income-based valuation, specifically through SDE and EBITDA. We'll also explore how to choose between them and provide real-world examples of each. If you'd like to learn what drives a higher valuation for your business, watch until the end. Electrical contracting businesses are service-oriented. Their value is not just tied to the tools or vehicles they own, but to their earnings, team, customer base, and operational systems. That's why many traditional valuation methods that rely solely on physical assets fall short in capturing the full picture. Let's begin with the asset-based valuation approach. This method is most commonly used for businesses that are not profitable or are winding down operations. It focuses on the fair market value of tangible assets such as work vans, tools, equipment, and inventory. You total the value of all business assets and subtract any outstanding liabilities. The result gives you the business's net asset value. This approach can be useful when the business doesn't have significant earnings or is being evaluated primarily for its equipment and materials. Believe it or not, many electrical contractors use this method to sell off their assets before retirement. However, in most cases where the electrical business is operating profitably, the more accurate way to value the business is through the income-based approach. This method focuses on how much money the business earns and how sustainable that income is moving forward. For small, owner-operated electrical businesses, the most common metric is SDE, or Seller's Discretionary Earnings. SDE represents the total financial benefit a single owner-operator receives from the business. To calculate it, you start with the net profit, then add back the owner's salary, personal perks, one-time expenses, and non-cash deductions like depreciation and amortization. Once you have the SDE, you multiply it by a market-based multiple, usually between 2 and 3.5 for electrical contracting businesses. This gives you an estimated business value. If the multiple is 3 times the SDE, it means the new owner would recoup their investment in 3 years, assuming steady performance and no major changes. The riskier the business, the lower the multiple. Lower risk or high growth potential leads to higher multiples. The formula is simple. SDE multiplied by the multiple equals the business value. The multiple already assumes the business includes all the essential operating assets such as trucks, tools, and working inventory. These are known as working assets, and their value is already included in the multiple. Valuation is typically done on a cash-free, debt-free basis, meaning the seller keeps any excess cash and pays off liabilities before closing. The buyer acquires the business with its working assets but not its debt. Let's say an electrical business has a net profit of $200,000. The owner also pays themselves a $90,000 salary and runs $10,000 in one-time expenses through the business. That gives an SDE of $300,000. If a buyer applies a 2.5 times multiple, the estimated value is $750,000. That price includes all tools, vans, and normal inventory required to operate. Now consider a larger business with a management team, multiple crews, and an owner who is not involved in daily operations. In this case, SDE isn't appropriate. Instead, we use EBITDA, which stands for Earnings Before Interest, Taxes, Depreciation, and Amortization. EBITDA is better for mid-sized to large electrical companies being evaluated by investors or buyers who won't be stepping into daily operations. Unlike SDE, EBITDA does not add back the owner's salary or personal perks. It only removes interest, taxes, depreciation, and amortization to give a clearer view of operational performance. Suppose a larger electrical contracting business reports a net profit of $400,000, interest expense of $20,000, taxes of $50,000, depreciation of $60,000, and amortization of $10,000. The EBITDA would be $540,000. If a buyer applies a 4 times multiple, which is common for well-managed and scalable companies, the valuation would be $2,160,000. Since this company doesn't rely on the owner and has strong systems in place, EBITDA is the more accurate and appealing metric for buyers. So when should you use SDE versus EBITDA? Use SDE for small, owner-operated businesses where the buyer will step into the owner's role. It reflects the full compensation and perks available to a working owner. Use EBITDA for larger businesses with management teams, recurring revenue, and the potential for investment or acquisition. It focuses on clean, comparable operating profit regardless of ownership. Beyond the math, what really drives value? A skilled team, clean financials, recurring revenue such as maintenance contracts, customer loyalty, and documented systems and processes that reduce owner dependency all help justify a higher valuation. These factors reduce perceived buyer risk and increase the multiple. On the other hand, poor records, licensing issues, high owner involvement, and lack of staff lower the multiple and reduce the value. The same holds true for larger businesses. A professionally run electrical contracting company with steady EBITDA and limited owner involvement might command a 4 times multiple or higher. One that is chaotic or overly dependent on the owner may only attract a 2.5 times multiple. If you're preparing to sell your electrical business and want to maximize its value, focus on building systems, hiring a dependable team, and keeping accurate financial records. These efforts reduce buyer risk and justify a higher valuation, whether you're using SDE or EBITDA. At the end of the day, valuing an electrical business is about more than just profit. It's about transferability, sustainability, and reducing risk. Whether you're buying or selling, understanding these valuation methods will help you make smarter, more confident decisions. On behalf of the MyShoeCovers team, thank you for watching. Please like, share, and subscribe to our channel. Check out our other videos where we provide valuable tips to help you grow your electrical contracting business.